Welcome back. A lot to unpack on this week's episode, especially looking at these CPI headline inflation numbers. What are they telling us? What are these core inflation numbers telling us about the direction that the Bank of Canada could be headed? And what other data points does the Bank of Canada have to maybe offset some of these negative inflation numbers, right? Looking at those business outlook surveys, looking at the consumer surveys that are conducted by the Bank of Canada, which help shape their direction. And taking all that data and looking at the current state of the Canadian economy, especially when we pit it against the US, what is it telling us about the course that the Bank of Canada could be headed? And obviously with all this data, sometimes it's hard to make heads or tails of all these numbers. And on this channel, we try to simplify that data, cut through all the noise, and share the exact points and thoughts that we have on these concepts. So welcome back to the channel. It's Friday, Finance Fridays, and I'm Anthony, your host with In Touch Mortgage Solutions. And if you haven't subscribed to the channel, we invite you to do so. Hit that subscribe button, hit that notification bell so you get notified every time we post a new video, and you can help us get this content out to as many Canadians as possible. And don't forget, while you're down there, hit the like button and share the video if you learned something. Always leave us a comment. Let us know what direction are we headed in 2024, especially as we kick off with this first set of inflation numbers. Now, obviously, these inflation numbers are for the month of December, and we got headline inflation coming in hotter at 3.4%, and that's up and obviously not a good place to be. But there are some differences in, the numbers. What are the numbers really telling us? And unfortunately, there's not really that much of a good news on the core inflation numbers, right? Core inflation meaning that it strips out things like food and energy. Even those numbers are up. And that's not really a good sign generally for the Bank of Canada, especially considering that, Stats Canada had to go back and revise the numbers for November. So even the numbers that came out originally, those numbers have been readjusted a little bit higher. And, this paints a different picture of the Canadian landscape right now. But to the defense of many economists who predicted, hey, where inflation rates were going to come in at, a lot of them have talked about this thing called the base year effect, and this is something we've talked about on the channel. So look at a set of data points, let's say from December of 2023 against December of 2022. Obviously, we saw inflation back in 2022 at 8% in June, July, those higher numbers. And as those numbers weaned off, as you average these numbers out, well, you're going to get some different, mathematical equations here. So the Bank of Canada is fully aware that, look, these numbers could be base year effects that are driving these headline inflation, core inflation numbers up, but it may be too soon to tell or right now, because we have to understand the Bank of Canada is looking at the data point, and when they look at these inflation numbers, right, they do tell a story. There's no doubt about it. But it does also tell a story about the months prior, right? The Bank of Canada wants to know what's happening right now. And although those numbers are harder to get to, especially, looking at specific data points, it is important to understand that even things like, obviously, fuel, gas has gone up. That's pushing inflation higher. We have things like recreation pushing things higher. We have food prices pushing things higher. And the biggest driver, as we've talked about, and it's been sort of the theme, is mortgage interest costs driving things onwards and upwards as more and more Canadians are feeling those pressures from higher interest rates, not only if they're in a variable rate, but obviously those who have renewed into higher rates and those that could be renewing into higher rates. So there's a lot of information there. When we look at these inflationary numbers, I think an interesting point is to look at the numbers for obviously November and December. And let's isolate and say, hey, wait a second, what happened in November and December? And obviously we had, those were holiday months or leading into the holidays, and a lot of individuals travel during the holidays. And we saw recreation tick up. Many Canadians, buying gifts, Christmas gifts, spending a little bit more as they're going out, they're visiting friends and family, maybe the trips to the LCBO, more food than normally is consumed. So all these things, definitely are playing into the equation, and, not ideal, but maybe the Bank of Canada will look through these numbers, hoping that the numbers that we get for January, when February hits, will be a little bit better. Remember, we have to take a look at those data points. I don't think right now that these higher inflation numbers will actually move the needle for the Bank of Canada. There's been some conversation about them potentially looking at a hike. Although it's not off the table to actually have a potential hike, I think the Bank of Canada is going to look at other data points, and we'll explore them on this episode. So Keeping that in mind, let's look at the consumer surveys, both from the business and consumer sentiment, what's happening right now that is actually a favorable outcome for the Bank of Canada. It may offset or counteract some of these higher inflation numbers, right? Remember, the Bank of Canada is very concerned with expectations, inflation expectations, what's happening with businesses, what's happening with individual spending and sentiment. So on the business front, we've seen business sentiment change, right? As the economy begins to shift, more and more businesses paying that CEBA loan that's due on January 18th, right? This is a loan that was issued during the pandemic where, you were able to get some money. And if you pay it back by January 18th, well, hey, guess what? You got to keep some money in your pocket and you can avoid some interest. But, you have to look at business expectations. Are businesses increasing the costs of their goods and services at the same pace they were just a few months ago or a year ago? And that has actually come down a lot for a lot of businesses. So that's some good news. Maybe we see that coming down the pipeline. The other thing too is wages. Wages are starting to fall off. We're not seeing the same pace of wage increases that we were a few short months ago. So this is obviously pointing the Bank of Canada to say, hey, things are shifting with businesses amongst other things, but it tells a lot of other stories, and we'll get into those stories in just a moment. Now, you look at the consumer side of things, obviously consumers are feeling the pressures from the higher interest rates, higher cost of goods and services, rents and mortgages. That should come as no surprise. But consumer expectations, right? What's happening with sentiment amongst Canadians is also shifting. Many Canadians who were surveyed believe that the Bank of Canada will get inflation back down to 2% by end of 2024, maybe early to late 2025, right? Depends. As these data points shift, we see that goalpost moving, but the actual concept is that the Bank of Canada will get inflation back down as they've made that their mandate. And that is allowing Canadians to say, hey, maybe I'm not going to make that big ticket purchase now. Appliances, car, home, I'm going to wait it out a little bit. So that was what's been shifting. And that's what the Bank of Canada is looking at. So that's a really good sign. I mean, obviously that could mean a few things, right? Canadians might be pushing those purchases out because they think it might be, not as expensive in the future. Maybe we'll see something change in the economy, or it could be because Canadians are just flat out broke, right? We don't have that many Canadians that can buy those items straight out or, finance them with these higher interest rates, especially cars and appliances, if, you're looking at those options. So there could be a couple of things at play here. So that paints a picture, right? When you look at these surveys, and we'll put them in the link below so that you can take a look at them for yourself and sort of see what you can get out of those data points. Because remember, data can be taken, it can be misconstrued. You can isolate and focus on one thing that sort of meets your narrative, but I think it's important to look at all these things in conjunction. Now, pulling from that, we look at the growth of the Canadian economy. We look at things like GDP, gross domestic product, what's been spent, what has the economy been doing over a specific time frame. And when you look at things like GDP that have gone from the $2 trillion mark, have come back down, right? Usually you want to see that increase. Well, what is that really telling us about the Canadian economy? Are we entering that recessionary territory? Have we entered that recessionary territory? Because Canada is a unique situation, especially, it's a lot different than other countries. It's the amount of immigration that is entering the country. And although we need new to Canada individuals to, yes, replace the aging population, come and work, because we are definitely in need of skilled trades and other particular healthcare workers. We have to create some tax revenue. We need these people to arrive here. But if you think about the bigger picture, when you look at things like GDP, and I mean, this is simple, right? This is a very simple way to look at it. You have more people arriving, which generally means that you're going to, maybe live with family at first, but they're going to rent a place. Even if they're living with family, they still have to eat, they still have to consume, they're still going to be buying things, right? And with more people in the economy and the GDP numbers, those growth numbers are not increasing, well, it's telling a very scary story. It's telling us, hey, wait a minute, usually we introduce people into the economy, that boosts up GDP, but it's not doing that in Canada. We're actually seeing GDP very flat. And when we see that flat or negative, well, that generally tells us that we could be entering a recession. Remember, the technical term or the technicality for recession is 2 months of consecutive, negative growth, or flat growth can tell us a lot, right? So depending on your definition, because we've seen governments across the board, move the needle on what a recession is. I mean, let's just look at the job numbers. Let's look at the unemployment. Let's look at GDP per capita, right? I like that term GDP per capita. I like looking at the individual well-being of Canadians. If we take these numbers, what is actually happening? And I believe Canadians are not feeling as rich as they were than just a few years ago. They're actually feeling less well off today than they were. And maybe they're not seeing wages go up. Maybe their job or their career doesn't give them the benefit of having these bumps in pay. So a lot of things are changing here. So let's look at the economy. If you think about unemployment's ticked up, right? And that's a big tell on what is happening in the Canadian economy. On top of that, we talked about immigration. So we have all these individuals arriving in Canada, but we don't have the jobs for them. So what happens when you bring in all these people and you don't have the correct match, right? I think there's a big mismatch happening between our immigration levels and not only our labor force, but our housing market, right? There's no actual alignment, right? We're not catching the right amount. And I think that's something that's been pointed out by the housing minister and obviously by the conservative leader, Pierre Poilievre. I mean, as I said, as these things adjust, we just have to look at immigration and say, hey, as we bring all these people in, right, we have inflation that's ticking back up. We have GDP that's flat. We have new to Canada individuals that should be increasing GDP, but it's not happening. And we have unemployment ticking back up, and we have less jobs being created. We have an economy right now that is solely and probably heavily weighted on housing. We're not as a productive an economy as, let's say, the US, who has a bigger manufacturing sector than in Canada. And they also, we have to look at production. We're not producing businesses and manufacturing jobs in Canada that will help increase the GDP of the country. We're looking at things completely backwards, at least in my opinion. So when you think about those things, we think about the entire outlook of the economy. It doesn't paint a very rosy picture. And if the Bank of Canada was to, let's say, hypothetically, increase its policy rate at this junction, well, that could really send shockwaves through the entire economy. As debt levels within Canada have rise to epic proportions. We've seen, consumer proposals, bankruptcy start to rise. We've seen many Canadians who have taken on these subprime mortgages, these private lenders, because of circumstances that we, multiple reasons why these people could have done it, but we're seeing this happening. We're starting to see it play out. And as these interest rates remain higher for longer, the pressure is really on the financial system. It's on everyday Canadians. It's further going to divide the gap between the wealthy and the poor, wiping out the middle class, because the rich can afford to, weigh out these options. They can afford to stay in a variable rate potentially a lot longer. And, some individuals that are trying to weather the storm, well, they're not going to have much option. So, we have to look at that. The Bank of Canada is going to look at that. Now, thinking about January 24th, what are some of the things that I'm anticipating to hear from the governor of the Bank of Canada? Remember, the Bank of Canada now has 8 meetings throughout the course of 2024. And following each meeting, they're going to have a press conference, which is unique to 2024. That's in order to help Canadians better understand what's happening in the economy. And we'll be tracking each one of those meetings on the channel. So make sure you're subscribed to the channel so we can break it down and simplify these things for you. Because a lot of times, even when we're listening to them, I have to go back and rewatch it a couple of times to be like, oh, I didn't catch that part. Oh, yeah, he said this. Oh, what does he mean by that? And this is exactly what the economy is doing and the markets are doing. The bond markets are doing the exact same thing. They're listening to the Bank of Canada. What did they say? What they didn't say is equally as important. So these are things that we're going to be tracking. And now more than ever, I believe the Bank of Canada is going to come up with some very aggressive language. They're going to basically put a lot of fear into the market saying, hey, we're ready to increase rates, if we see things not shaping out the way they want, but they are going to signal that there are some major, deficiencies in the market as well. So I think the Bank of Canada, based on what we're seeing happening right now, and I could be wrong, let us know in the comment section below. I think the Bank of Canada is going to extend their pause at least for the first 2 quarters of 2024. So well into the, let's say, spring to summer range because of these higher inflation numbers that came out in January for December. So I think that's going to push the can down the road. And I think that's the case as well, because if we look at the US, we look at what's happening there, even though their economy is a lot different, we have 2 different paths for the Canadian and the US economy. The US economy is doing a little bit better, but they have potentially, depending on what type of news outlets you're following, 3 to 6 rate cuts, some predicting a rate cut to start from March and every single meeting after that. I mean, look, the predictions are everywhere, right? This is the reality. And, if we're gonna take that to formulate a decision, it's very challenging. Most Canadians, most people that I talk to, they don't live in a spreadsheet, right? They don't. They look at their situation right now, they're saying, Ant, I gotta move. I can't stay here. My landlord's kicking me out. They're selling or so on and so forth. They're making moves based on their situation. They're not basing it on, a spreadsheet. So with that being said, obviously we have to look at what's going to happen with Canadians. And the Bank of Canada is going to be very hawkish coming out on January 24th. We'll be talking about that when that announcement comes on our Finance Fridays episode. But more importantly, if you're, thinking about getting into the market, looking at the options, you're looking to get a pre-approval, we could see some shift in these bond prices because as that announcement came out from inflation on earlier this week on Tuesday, well, that did move the bond market up a little bit. And as the markets digest the data, configure when they think the Bank of Canada is going to cut, that could move the needle for fixed rate mortgages, as the 5-year Bank of Canada bond is generally the best barometer to gauge financial instruments like mortgages and loans. So when do you think the Bank of Canada is going to actually cut rates? We think that the Bank of Canada will have to cut rates at some point in 2024, but the severity or the magnitude of those cuts may not be what everybody expected. Remember, Bank of Canada wants to see and make sure that inflation is absolutely dead and gone before it decides to cut rates. It does not want to have what happened in the 70s and 80s relapse, where we saw inflation tick up, they brought it back down, then they moved interest rates lower, and then boom, inflation shot back up, and they had to really tackle it. And I don't think our Canadian economy could withstand that type of pressure. And obviously with recessionary fears looming, what do you think is going to happen? But we'll leave the video here. Wishing everyone a wonderful Friday and an even better weekend ahead. Until next week, thanks for watching.